Welcome to The Explainer, everyone. Today, we're unpacking what has to be one of the absolute most baffling corporate collapses in modern history. And honestly, this isn't just a story about a business failing. It's a story about human psychology, the crazy illusion of success, and exactly what happens when the supposed smartest people in the room literally forget to do basic math. Yep, we're talking about WeWork. Just take a second to process the sheer scale of this shock. $47 billion down to, well, zero. To put that into perspective for you, this company was worth enough money to run an entire small country. And then, in just about 6 weeks, that massive mountain of wealth completely vanished. There was no natural disaster, there was no war, no sudden global economic crash. This monumental collapse was driven purely by the magic of words and the bursting of a meticulously crafted bubble. So let's start with part 1, selling a magical movement. Back in 2010, a guy named Adam Neumann founded this company. But here's the thing, he didn't pitch it to the world as a traditional business. He pitched a $47 billion illusion. His whole pitch was basically, we're changing the world. This isn't just a business, it's a movement. And you have to hand it to him. Neumann was an absolute master at selling an emotion and a dream. He made investors and employees feel like they were part of something historical and transcendent, rather than, asking them to look at a tangible, grounded business model. Because when you sell a movement, people kind of stop asking questions about actual profits and start focusing entirely on the vibe.
But let's just strip away all that glamour for a second and look at the blunt reality. What did WeWork actually do? It was office rental. That's the whole shebang. It was the incredibly simple act of renting a really massive office space, breaking it up into smaller, trendier sections with, some nice espresso machines and neon signs, and then subleasing those sections to freelancers and smaller companies. It's a traditional real estate business. It was just dressed up in the shiny clothing of a Silicon Valley tech startup.
So you might be wondering, how does a basic subleasing company get valued higher than major global airlines combined? 12 minutes. That is literally all it took. One major investor was taken on a 12-minute office tour. He didn't dive deep into spreadsheets. He didn't thoroughly analyze the market data. No, he made a decision based entirely on vibes, the energy in the room, and Adam Neumann's sheer, unadulterated confidence. That 12-minute tour resulted in hundreds of millions of dollars in investment, fueling a hype machine that pushed the company's valuation to that dizzying $47 billion. Which brings us to the inevitable breaking point. See, a private company can hide a whole lot behind closed doors. But what happens when a company this massive actually has to open its books to the public? In August 2019, WeWork filed its paperwork to go public with an IPO, meaning they wanted to sell shares on the open stock market. And to do that, the law requires you to show everyone exactly how much you earn and exactly how much you spend. Which leads us right into part 2, the disastrous financial math. Because once those real books were finally opened up, the public didn't find a tech giant at all. They found fatal financial math. And this brilliantly illustrates the absolute core of the problem. Just look at the breakdown here. For every single dollar WeWork earned, they were spending approximately $2. Imagine trying to run your own household budget like that. You make $1, but you spend $2. It is completely unsustainable bleeding. It really doesn't matter how fast a company is growing if the losses are growing even faster, right? It's just a matter of time before the cash completely runs out. But honestly, the cash bleeding wasn't even the scariest part. It was the structural risk they built right into their foundation. WeWork signed leases with building owners that locked them into paying rent for 15 years. But then they turned around and rented those exact same desks to their tenants on flexible, month-to-month contracts. In simple terms, WeWork was on the hook to pay landlords for over a decade, but their own income could completely vanish in 30 days if their tenants just decided to pack up and leave. It's an absurd, terrifying mismatch of timelines. They were completely exposed to massive long-term debts with zero guarantee of long-term income to actually pay for it. Now, what's really interesting about this is the sheer audacity of the leadership while all this was happening. While the company was bleeding money and taking on all this massive risk, Adam Neumann was personally profiting. He literally trademarked the word "we" in his own name, and then he turned around and sold that trademark back to his own company for $6 million. He took millions from the very company he was supposed to be leading just for the rights to use a 2-letter word. It was a glaring red flag about how unchecked his power really was.
Once this disastrous financial math and these bizarre self-dealings were made public in the IPO paperwork, the reaction was swift. We're talking about a total, absolute collapse of confidence. Because what happens when the illusion shatters in a matter of days? Notice I said days. This didn't take years to unfold. The market looked at the basic math, realized the emperor had absolutely no clothes, and the whole thing just imploded.
Which brings us to part 3, the sudden unraveling. The sudden unraveling of WeWork is easily one of the most brutal market corrections we've ever witnessed. The hype completely evaporated, leaving only the grim reality of those spreadsheets we were just talking about. Let's walk through exactly how fast this went down. In August 2019, that IPO paperwork reveals the truth. Within just weeks, the $47 billion valuation tanks to $20 billion, and it just keeps falling. By September 2019, the board is forced to step in and remove Adam Neumann as CEO to try and stop the bleeding. But the damage is structural, it's deep, and despite massive efforts to keep it afloat, the timeline ends in November 2023, when WeWork officially declares bankruptcy, a total ground zero reset. But we have to ask, who actually paid the price for this collapse? We're looking at a pretty devastating juxtaposition here. When Adam Neumann was ousted, he was handed a golden parachute. He walked away with over $1 billion in cash, stock, and benefits. Meanwhile, everyday employees, many of whom took way lower salaries in exchange for company stock they genuinely believed would make them wealthy, were left with absolutely nothing. Their stock became completely worthless overnight, and thousands were fired, sometimes in brutal 3-minute online meetings. The architect of the disaster got rich, while the believers lost everything. In the middle of all this wreckage, one of the original major investors, SoftBank, basically panicked. They had already poured so much money into WeWork that letting it just die would be a massive, humiliating public defeat for them. So what did they do? They poured in nearly $10 billion more just to save face and keep it on life support. It's a textbook case of throwing good money after bad, driven way more by pride than by sound financial math. And as we saw from the final bankruptcy filing, it ultimately failed anyway. But hey, if you thought this story was over, you are definitely underestimating the wild, wild world of high finance. Because here is the real twist. Today, Adam Neumann is back. He started a brand new real estate business. He even reportedly tried to buy back the bankrupt WeWork. And the most astonishing part of all this, some of the exact same investors who lost absolute fortunes on his first venture are lining up to fund him again. No way, right? But it just goes to show that a charismatic storyteller can sometimes defy all logic and past performance. So, let's wrap this up with part 4, 3 expensive lessons learned. We really can't just look at this as crazy entertainment. There are real, highly tangible takeaways from this disaster. So the crucial point is, let's distill this incredible saga down to 3 business rules that were blatantly ignored. First, check the numbers. Never, ever trust a good story or a movement without actually verifying the hard facts and the cash flow. Second, avoid the timeline trap. Do not pair long-term 15-year costs with short-term, month-to-month income. It is a guaranteed recipe for disaster. And finally, demand accountability. Giving one single person total, unquestioned control where they can just trademark a word and sell it to themselves for millions, yeah, that's incredibly dangerous. What's really important to remember here is that the core idea wasn't actually bad. Shared office space is a perfectly viable working business model. It's used by tons of successful companies today. The concept itself wasn't the problem. The problem was selling a dream instead of a spreadsheet. The problem was unquestioned leadership acting completely without boundaries. And this brings us to a final, provocative thought I want to leave you with today. The founders spun a brilliant illusion, sure, but the smartest investors in the world willingly bought it without even checking the math. So was this entirely Adam Neumann's fault for selling the lie, or do the investors share the blame for being so reckless with their billions? It's a fascinating question about accountability in the corporate world. Think about that, let us know your thoughts in the comments, and always keep questioning the story behind the numbers. We'll see you in the next explainer.